When you see people today talk about the risks of the debt and the deficit, you often see the response to that is people said, "Well, people have been concerned about this for decades, and look, nothing bad happened." And it's funny when you look at when the national debt clock went up. That was the late '80s. Ross Perot ran the most successful independent presidential campaign in modern history, based on largely debts and deficits in the early '90s. That period was kind of the peak zeitgeist for public concern around the debts and deficits. But the phase we went to for the next 3 decades was that China opened up to the world, Soviet Union fell, basically large amounts of labor and resources got connected to Western capital, a big burst of globalization, very disinflationary. And so we kind of had this period of 30 more years of falling interest rates. And that offset a lot of our public debt accumulation. So if you double your debt but you cut your interest rate in half, your interest expense still seems quite manageable. And I think people got lulled into a false sense of security that they kind of said, okay, we were worried about the debts and deficits. It turns out we didn't have to worry. We're fine. And then now people kind of, I think, the pendulum swung the other way that people are saying, look, what we've learned is that they don't matter. But I think the key risk is that our interest rates have now they bounced off zero. They're now going sideways to up. I think we're in a structurally like no longer declining interest rate environment. And when you have accumulated debts and deficits and interest rates are just going sideways, let alone up, that offset's gone. And the debts and deficits actually start to matter quite a bit more. And then, as I said before, when that sum of fiscal deficits is larger than the amount of net bank loan creation, or even the sum of net bank loan creation and corporate bond issuance, um, that's just a much bigger factor on the economy. And then, in addition, you can get to a point where the Fed rate hikes they lose their effectiveness to fight inflation.
Did you know that as of today, the US national debt stands at over $32 trillion? Financial expert Lyn Alden warns that we may be facing an economic time bomb. With interest rates no longer declining and the national debt continuously rising, the risks are mounting. For decades, we believed that deficits didn't matter. But as Lyn explains, the current environment is different. Higher interest rates mean higher interest expenses, and this time there's no offset. When you have accumulated debts and interest rates going sideways or up, the deficits start to matter significantly more. The Fed's tools for controlling inflation, which focus on bank lending, become limited and sometimes even counterproductive when fiscal deficits are the primary source of new money creation. If the deficit is the primary source of new money creation, the Fed's ability to control inflation diminishes, potentially leading to structural inflation beyond our control. What does this mean for the US economy and your investments?
Because if you have an environment, let's say back in the early '80s, where public debt is 35% of GDP and most of the money creation is coming from bank lending, if you raise rates super high, you do blow out the fiscal interest expense to some extent, but you put a lot more downward pressure on that private sector lending. And so that tends to be a net disinflationary effect. On the other hand of the spectrum, if you have fiscal deficits are larger than bank lending, and you have an accumulated stock of over 100% debt to GDP on the public ledger, when you raise interest rates, which is what we've seen in the past couple of years, you do put some downward pressure on bank lending, but also you blow out the interest expense of the federal government by an even larger total number than the slowdown you did for bank lending. And so it has a less disinflationary effect than it would if you had only, say, 35% debt to GDP. And if you go far enough, like if you get to where Japan is and you have something like 200% debt to GDP, then rate hikes could even be inflationary under certain circumstances because almost none of your money growth is coming from bank lending. It's all coming from monetized fiscal deficits, and interest rates increase those fiscal deficits. So yeah, that is how I describe the doomsday scenario. That's the limiter, is that we get structural inflation that is beyond our ability to fight with all the tools that we're used to doing, because all the Fed's tools for controlling inflation are really about accelerating or decelerating bank lending, and they really don't do anything about the deficit. So if the deficit is the primary source of new money creation, then the Fed's tools become limited and sometimes even counterproductive. To answer your other question, basically, I don't view it as sustainable. I think that these situations can go on a lot longer than people expect, but it doesn't mean that they're sustainable. Basically, this phenomenon is not new to, say, emerging markets. It happens to emerging markets all the time. They have a lot less rope they have a lot less road to go down because their liabilities are denominated in currency that they don't control. They're more reliant on external capital. The U.S. has a ton of road, or historically had a ton of road. I think people overestimate the amount of road that it has when the interest rates are no longer structurally declining. Um, and so I do basically think that the long-term outcome here is on average higher inflation, and inflation that is less able to be controlled by central bank policy of tightening. And that really the only way to try to get a handle on it is to deal with the deficits. But a lot of that is structural. It's basically accumulated decisions over decades and things that are kind of third rails in politics to touch, and it just becomes a very hard problem to solve. Which is, yeah, I'm not very bullish on the strength of currency or the reliability of bonds as long-term investment vehicles because of that underlying situation. One kind of background point I would make is that when people talk about debts and deficits in the US and they talk about it being like a doomsday scenario, for people that kind of study global markets, in a few weeks, I'll be back in Egypt. I go there every year. They're dealing with something like 40% inflation right now, and life goes on. It's obviously not great, but the things that people think of as the end of the world are happening all the time in multiple countries as we speak, at higher magnitude than any of this likely leads to in the near term. So I think that's the optimistic point there is that there are always things that are more extreme. There are People are adaptable. Systems change over time, and the end of one system or the switch off from one system to another system is often more of a handoff. And apart from the biggest tail risks in the world, like nuclear war or something like that, life goes on, right? So I generally don't like the phrase that it's doom, even though it is serious. I think so, but the main challenge there is that, and this is kind of unique to the U.S. Our tax receipts are very tied to asset prices. It's kind of just, especially since the 90s, because a large
Oh,
portion
okay,
of
yeah.
taxes are from wealthy individuals.
So people exercising their NVIDIA options.
Exactly. Yeah. And so you'll
Right.
generally
Yeah.
see with a short lag, tax receipts follow asset prices. So if we were to pivot toward austerity, there's a decent chance we would get kind of flattish asset prices. And then therefore you could ironically continue to widen the deficit anyway. It's a very hard tailspin to get out of. You'd have to, I think, not just tweak your revenue and spending model, but you'd have to kind of overhaul some of the ways it works, which would make it even harder to do in a very polarized environment. Um, Generally speaking, when countries get out of this, like we got to similar debt levels in the 40s, we had much better demographics back then. We had a much stronger manufacturing base. But basically, what countries do when they find themselves here is they generally run financial repression, which is that they hold rates below the inflation rate. It kind of slows down the interest expense of the public ledger, and therefore can kind of slow down the money supply growth. It makes your currency fairly undesirable to outside entities, which is not what we're doing right now. That's what Japan's doing, but I think that's kind of in the cards for the U.S., which is basically that we're going to have a period of time where interest rates are just not really keeping up with inflation. If you're holding currency or bonds, you get kind of gradually devalued. Um, Technology and part of what disguises the inflation is that we think of inflation as being compared to zero, but the baseline inflation rate is negative because over time technology gets better, things get cheaper to produce, but they go up in price anyway because of how we run our money. And so any sort of technological gain is also contributes to the possibility of soft landing because as you get better at making stuff, if you're running money supply growth at 10%, but you're 5% more productive at making things every year, then actual prices on average might only be going up at 5% per year. That's kind of historically how countries try to grow out of this type of situation, but normally they don't do so without a pretty big currency devaluation along the way. And that generally shows up in whatever's scarce. So generally, the high quality assets go up a lot in currency in those environments. If you get any sort of dislocation in energy production for a period of time, like if you're just not growing or capex is not happening and you get a currency devaluation, that can show up in higher prices. That's generally what triggers pain in emerging markets is some of their key imports get very expensive. Um, so there are ways to kind of smooth it out over a long period of time, but it's very hard to kind of structurally fix it until there's basically a big change in how taxes are done, spending's done, and probably the overall currency level as we kind of know it now.
In today's enlightening discussion, we delved into the intricate economic landscape of the United States, skillfully guided by Lyn Alden. From the historical context of debt and deficits to the evolving dynamics of interest rates, we've unpacked the nuances shaping our financial future. It's imperative to grasp these complexities to make informed decisions in an ever-changing economic environment. If you found today's insights valuable, don't forget to show your support by liking this video, subscribing to our channel for more insightful content, and sharing your thoughts in the comments section below. Your engagement not only enriches our community, but also helps us continue delivering valuable perspectives on finance and economics. Thank you for joining us on this journey, and together, let's stay informed for a brighter financial future.